Doc, audio is good. You should basically just click the Start Desktop Sharing at the top and then choose which monitor to project. All right, there's that magic wheel.
All right, are you getting me okay as far as audio?
Audio is good. We can see your screen as well, so you can go ahead and take it away in the next.
Okay. All right, very good. Morgan, thank you very much. I wanted to say up front how much I appreciate being here today to share some time with you guys and taking your time out of your weekend to learn a little bit about trading. Now, I've got the food coma shift for all of you that just ate lunch, so I'm going to like to ask is that we hold off on the questions until we get to the end, if that's possible. So I don't know if that's appropriate or not, but I'm going to see if I can get you guys back on time and get you back to your weekend. All right. Okay, lunch or breakfast, very good. Okay, so welcome to the Trading Pub webinar, and my name is Doc Severson, and away we go here. Now, who is this Doc guy, besides being a poster child for Rogaine? Who is this? I produced a daily market options newsletter since 2005, and I've mentored thousands of students during this time, and I'm happy to see a lot of them actually are on the roll call for today. So welcome aboard, guys. I am a husband and father of three, and it's getting kind of scary because the father of three part has turned into driving. And my passion is actually to cycle for charity. I love when things get a little bit warmer out there, I love to get on the bicycle and raise funds for cancer research. It's something I'm very passionate about. So, hello, Johan. What else do I believe in? I believe that this is no longer your father's stock market. I don't believe that if you take a zoom out of the stock market and look at whatever you want to look at the Dow or the S&P or whatever you want to look at, ever since 1990, this thing has just been on a tear. The volatility is just much, much larger than what we're used to a couple of decades ago. So all of those axioms that you've heard in the past, 10% a year, these kind of things, you can kind of throw them out the window because this is a completely different market and we need different skills and tools to be able to trade this. I also strongly believe in the power and opportunities that a free market will continue to provide. So as long as we can keep this a free market, there's no reason why we can't adapt our strategies to be able to trade this. Okay? I believe that one of the most important steps that a trader can make is to turn off the news and focus on the charts only. And sometimes that can be very, very difficult to do. And most of you should know what I'm talking about here. It's very difficult to tune out the bias that the news provides and actually just focus on the charts. Once you're able to do that, I think you will see your performance improve when you stop going with the herd. All right, what else do I believe in? I do believe in performance through consistency and not home run trades. I'm very, very consistent because I'm not shooting for home runs every month. This is an equity curve of my newsletter that I've had for the past 8 years. And before I will risk my capital. So there's many times I'll sit on the side or go to very small positions instead of going for home runs. And I also strongly believe in risk management. It's not what you collect, it's what you keep that counts over time. And that's the one big difference that I found with traders that are working either on the floor or off the floor in Chicago versus most of us out here in the retail world is we're more focused on what we can make on a trade, not necessarily what we risk. That's a huge difference, and I think we need to close that gap. So now that you know where I am coming from, let's shift to the WIFM. If you've never heard of that expression before, that's what everybody that's watching a presentation is sitting there thinking about every 10 seconds. What is in this for me? So what's in this for me? So I'm going to keep giving you guys some WIFM here as often as I can. So what am I here to talk about? We all start in the same manner, right? We all start with stocks and we learn the same old technical analysis techniques. It looks pretty easy in the seminars that we attend, but it really is very hard to duplicate in today's market. Hasn't it been? It's not that easy. You come out of that seminar, you think, wow, this stuff is easy, and then you put it in play in today's market. It's not quite the same. So today's market is different. It's very, very different. We recognize this guy, right? What used to be a rumor in 2005, I remember all the blogs and everything, like how the government stopped reporting M2 money movement, and everybody was all like conspiracy theory. Oh, they're printing money, and they must. No, there's no way they could print money. That couldn't happen. Well, now it's happening right in front of us, right? We're printing dollars out of thin air to stay in front of our liabilities, and today it's happening, and it's happening right in front of us, right? So all of this money has to find a home. It has to go somewhere. It's just all this flood of liquidity. We're trying to goose the market. We're trying to push things higher. So with interest rates near 0%, it's not sitting in money markets. It's finding its way into our stock market. That's for sure. So the standard tools and techniques, so what was a fairly quiet bull market that we had from 2003 to 2007, all right? Nice strong bull market, but the majority of it during the middle part was very, very quiet, very choppy. People had a difficult time with that bull market. But it's far different from today's cyclical bull market that started in 2009. You can just see the difference in the volatility. Just amazing. What's changed is the volatility. You can see that the runs within this cyclical bull to the upside are much stronger. They just tear, right? But also the corrections are much, much deeper, aren't they? Very different from the bull market that we had in 03 to 07. And we'll no doubt have the same thing happen when the bear comes. When the bear does come, and it's coming, but not just yet, not until your barber starts giving you stock advice will the bear come, right? We have to have that euphoria kick in, just like what we had in 2000, just like what we had in the late 07, before we're going to have a turn in the market and the bear is going to come. So it's not coming next month, guys, not yet. So how does this make trading harder for investors using standard tools and techniques? How does this additional velocity make things tougher for you guys? Well, let's go back to 05 to 06. Okay, here's the volatility that we had. Very choppy, slow-moving price action. It worked great with, yeah, Ted, no barbers here. Number 2 with a hard press. That's all it takes. So 05 to 06, all we had was variable for that. I remember there was a tool out there called the market forecast, and everybody thought it was just, minting gold. Oh, we have a triple cluster on the market forecast, and people would just literally climb over themselves to get on board with this tool because it was magic back then. But then, of course, when everybody sees something start to work, it stops working. And in these days, right now, and I'm calling this 2012 plus volatility, so we've seen this really last year, the year before that, trends go for miles without significant pullbacks. And then they reverse and they do the same thing again. Okay, so if we're using standard tools, the ones that you all learned when you first started trading, so an oscillator like stochastics, when we look at this, we'll get completely, we're going to show crossover after crossover without reaction by the chart. So investors are either on the sideline waiting for something to happen, or they're being chopped up by these unusable signals. I just hear lots of complaints out there that people are just being chopped to death by some of these moves. They're waiting for they're shorting too early, they're seeing crossover, so they're taking the short side, they're getting frustrated by being, short covering again. Squeeze after squeeze. Okay, so the next thing that people usually learn is that once they learn their indicators, they learn how to read divergences in there, right? So divergence, that's the secret method of the professional trader. So we see price making higher highs, and we see an indicator making lower highs, and we say there's a divergence, there's a great signal. Even Alexander Elder called it this his strongest signal in technical analysis probably 10 years ago. Alexander Elder, Mr. Trading for a Living, okay? Great guy, great author, okay? But that signal was 10 years ago was his strongest signal. I would say it's probably not his strongest signal anymore because, again, signal after signal after signal, nothing going on there. Okay, these are just not producing usable signals in the face of a withering trend, right? Yeah, like Eric says, it's not a signal, it's just an alert. So eventually you get a reversal, but only after multiple false positives forever. So when you finally give up on the fact that this trend might ever stop is usually when it reverses. So what do? What are you going to do about this stuff, okay? These standard tools that work so well during the choppy years, they don't work very well in today's QE field market. When we get all this money looking for a place to go, it's going to go forever, all right? So we can go through our list of 200 plus indicators in our charting package and see which one curve fits the best. I mean, it sounds like a nice fun thing to do over the weekend, right? Or we can just rethink the problem. Yeah, you know, Woody can probably tell you what temperature it is outside based on what the CCI is showing. I mean, if you spend 20 years watching the same indicator, you can read it as well as price. There's nothing wrong with that. But you know, what can we do to rethink this problem? Well, maybe we can learn from nature. Have you ever noticed that we do our best to come up with ideas on our own, but we tend to over-engineer the solution? Okay, we end up with something that works but is cumbersome, and then we have to go back and look at nature again. So sometimes the best solutions that we find are found in nature. So let's go to the birds. We've come a long way in a very short period of time with our aviation, right? You know, so 100 years ago we were flying biplanes at 70 miles an hour. And now we're going Mach whatever, we're putting people on the moon, or where we used to put people on the moon. And it's just amazing how far we've come in just a very short period of time. But our aircraft wings are still inefficient. We're seeing a vortex. Centuries ago, we'd see that birds have already solved this problem with their wingtips. Look at the way that they spread out at the very end. They prevent that vortex from coming off the edge of the wings. So they've got this problem solved way before we even thought that we knew about it, right? So what we did was we say, well, let's just copy nature. Aircraft designers stole this idea and applied it to aircraft wings by putting the winglets on. And there you go, Eric, 10% improvement. Planes can now fly further on less fuel, okay? Mount Everest. How do we go about climbing Mount Everest? Well, one does not simply sprint up Mount Everest, right? Base camps are there for a reason. So the body can acclimate itself to the increasing oxygen levels and rest from the climb. You ascend as far as you can and then you rest. Repeat, right? You go up to Camp 1, you get used to the oxygen there. You go up to Camp 2, you do the same thing over again. The same thing over again to Camp 3 and then Camp 4. But it's also very common for climbers to tire. They get up to Camp 4 and they can't hack it up there. They're just not used. They've come too far too fast and they've got to pull back to Camp 3 and reacclimate themselves to that low oxygen levels. They've got to rest. So isn't that how markets move? Isn't that the same way that markets move? So don't we see things like this where the markets are heading up and then they rest for a while, they head up, they rest, they head up, they rest. They advance as far as they can and then they rest for a while. There's some good comments here. So markets are just like big organisms, aren't they? They work just like us. They run as far as they can on the initial excitement and then they finally exhaust themselves, just when it seems like they will go forever. They have to rest in a sideways to down fashion until they've recuperated, at which point the former trend continues, or potentially even reverses depending on what price action does. So how do we measure this? Okay, sounds like a great concept, but how in the heck do we measure something like this? We've already shown that tools like stochastics, I didn't show RSI, but it does the same thing too. It's just another oscillator. There's nothing magic about it. MACD, the same thing, essentially useless in identifying turning or exhaustion points in these QE field trends. So we can always fall back. Somebody mentioned before me, I am 100% behind reading price action, and that's really one of my big things these days, is stripping everything out from the chart except for price action. And we can verify a change in polarity, we can use candlestick analysis, anything we want to on that, okay? And we can identify these turning points in the trend. But here's my point, and this is what I want to talk about today. Wouldn't it be great to anticipate that turn instead of just reacting from it? Anticipate that turn instead of reacting from it. So that's the point here, is it's nice to anticipate things and be proactive, right? So are we looking in the wrong place? Maybe we're using the wrong tools and trying to measure markets in a way that doesn't work. You know, what worked 10 years ago for Alexander Elder is not working today. What's going on? What do we do? So if markets are similar to other natural organisms, then maybe they also follow the rules of Sir Isaac Newton. You remember Newtonian physics, right? So this should seem similar to you here, this diagram. We've got this cyclist who's gotten up the hill, he's raised his potential energy, and then as he goes down the hill, all that potential energy goes out in the form, is expended in the form of kinetic energy. We all understand that, right? We all get that stuff from grade school. So the process repeats itself over and over again with a body in motion. It's continually going from a state of potential to kinetic and back and forth and back and forth. Constantly. Every time you walk up the stairs, you're adding potential energy. Every time you go down the stairs, you're expending kinetic energy. So it's just like a price chart. Yeah, this is not Lance Armstrong. I'm sorry, I should have picked a different color jersey there, guys. So can we apply this principle to markets and figure out a way to measure this energy? Okay. Let's look at this price chart and understand the potential versus kinetic. So these green lines here, these green arrows are where markets convert potential to kinetic energy. And the red arrows are where markets are storing potential energy again. So it's going between potential and kinetic energy, okay? Yeah, Greg LeMond. So trends burn up a lot of energy from a market. I want you guys to understand that. There's one thing you walk away from this today, is that understand trends burn up a lot of energy from a market. It takes a lot of new participants or fuel. It takes a lot of that sideline cash. Every last bull's got to get in by the end of the trend, right? Otherwise, it can't keep going higher. Money's got to keep pushing it up to raise that ask price. This is kinetic energy being expended, and there's only a finite supply of it. There's not unlimited, even though I just said that we're printing all this money. There's only so much to go around. Trends cannot go over forever before refueling. So when trends burn up all of their energy, that means that there's no new energies coming in from the sidelines. This is where the chart must rest and build up potential energy for the next trend. It can do this through recharging in 3 different ways. So there's 3 different ways we're going to show you how to recharge. Number 1, big pushes higher, look for a sideways movement. Okay, this is where we're seeing a coil. It's almost like the chart is coiling up, almost like winding a spring again. And when you wind a spring, aren't you increasing that potential energy, right? It hasn't been released in terms of kinetic energy yet. You're winding that spring. That's number 1. Number 2, is we'll see just an outright pullback. Here's just a pullback. A quick, sharp pullback actually restores energy faster than the sideways coil. And then here's number 3. After a strong move higher, it can actually recharge on the fly, but it's got to do so very incrementally, is to see the price slowly grinding higher with very incremental gains. So this can do so almost infinitely, actually, depending on what we show with the higher time frame charts. So summary, 3 ways to recharge. The fastest way is a quick, sharp pullback. The medium is a sideways coil, or what I call railroad tracks, where it almost looks like you have railroad tracks where you have the price just kind of walking sideways. Boom, boom, boom. We had about 3 or 4 days of that just last week. Railroad tracks. And the slowest is the continued upside grind, where you just get this day after day after day of maybe 2 points in the S&Ps, 1 point in the S&Ps, 2 points, 2 points, 1 point, day after day. It will recharge itself on the fly. It's amazing. So most recharging patterns will be a combination of these. So how do we measure this energy? Using standard physics units of joules. We're not going to plug some meter into the market and measure the joules, right? Not going to be able to do that. We need something different. But we can look at the linearity of a trend, the linearity of a trend. The more linear a trend is, the more money's coming straight in every day. So let's look at the linearity of a trend. A long straight uptrend or downtrend is very linear. It takes a great deal of energy out of a market to keep price moving in the same direction constantly, day after day. A lot of energy to do that. Conversely, though, a choppy market, one that's going sideways or just sort of pulling back or going counter trend, is nonlinear price behavior. This is where we're consolidating. This type of price action restores energy to a market. We're going to get to an application here in just a minute. So if we can just measure the linearity of price movement, we have a correlation to the amount of energy entering or leaving that market. This is where a little-known indicator called the Choppiness Index comes into play for us. Not a lot of people have heard about this one, but it's a very obscure indicator. Some people don't even have it on their available indicator list. So here's how we're going to apply this to the chart. We have a daily chart of the S&P up here, and I've got this Choppiness Index set up with a period of 14. So what I'm going to look for is, I've got some horizontal lines up here. Anything over a level of 55 means it's non-linear or charged up price action. You can see that we had that in late June, early July. We had that at the beginning of September. Also, about halfway through October, we had some of this, as well as at the very end of December, we had some non-linear price action, right? Less than 38.2. This is the yellow line that's coming up here. This means that the market has expended a lot of energy through a trend. It's been in a strong trend, and the odds of reversing or consolidating at that level or below are starting to get very, very high. And then finally, when we go below 30, this is highly likely that the trend is going to die at this point. Highly likely that the trend will die. Price can do whatever it wants to. All we're looking for, remember, we're watching price action to look for actual reversals, things like that. I'm not saying this supplants price action, right? We're still using price action for understanding which direction things are going. But this is giving us an early warning that things are about to die. Okay, so under 30 is highly likely that the trend is going to die. So let's put this to action, okay? Let's apply this. Let's look at places on this chart. So we're looking at 2012 into early 2013. We have early July, okay? So we have a level over 55, and we're looking at this price here. It's ready to trend. It's telling us it's ready to trend, okay? And then when we get to mid-August, it's almost near 30, isn't it? It's exhausted. And it's this level right there, it's telling us it's just about done. Now, when we get to early September, it's flipped that again, hasn't it? It's coiled sideways for about 2 straight weeks. Right there, okay? And it's ready to trend again. It's charged up. It's telling us, look out, this thing's going to, you know, the analogy I always use for something like this, because I was a bad kid in junior high school, I would take my orange and get my lunch, my orange and the orange seeds from there, the pits in there, and I'd squeeze them really hard and they'd fire across the room and nobody would ever know where it came from. Well, that's the analogy that I use for this, is that it's going to come firing out of there. It's coiled up and it's ready to go. You don't know what direction it's going to go. That's what you use price action for. Oh, they're coming to get me now. Okay, the next one we have here is mid-September. Mid-September. Oh, they found me. I'm in trouble. Mid-September here, we have an exhausted chart again. Look at this. An exhausted chart, and I recall at this time we're trading this, we're saying this thing cannot go any higher. It's done. It's toast. Okay? Yeah, and the clinker. If I can't finish this webinar, can somebody finish it for me, please? Okay. So that's mid-September. We said this thing is toast. It just can't go any higher. We had this parabolic tail going for it. And look at that. It went sideways. It went sideways for almost 2 weeks there before it started getting really, really unstable. You just can't go forever, especially a parabolic tail like that. Okay, mid-October, there we go. We're coiled up and ready to go again. It's ready to trend. Which way is it going to go? We don't know. We're going to watch price action to understand if it starts to go into lower highs and lower lows, which it did. Okay, and then we had a downtrend, which was actually a very mild downtrend. The one that we had from October to November, it was actually a very slow, very grinding downtrend. It was one of the most odd downtrends that I've seen in a long time, especially from a weekly top like that. So it didn't really generate any reversal signals down at the bottom, but when it reversed hard and it showed us on price action that it had reversed, then we're looking at early December. We're saying, okay, this thing is bounced off the bottom, it's exhausted, and it's going to have to consolidate again. And here's one of the latest signals that we had, was at the end of the year, we said, ready to trend, look out, here it comes, and bang, look at that. But only a few days later, this thing is exhausted again. And this is what we almost, I believe I took this snapshot on Wednesday or Thursday, and we'll get to today's application in just a couple of minutes here. So here's how we apply the choppiness index. Keep in mind that this indicator does not signal the direction of the next move. It doesn't show you the direction. It just shows you a reading on the relative amount of energy expended on a trend and when it's likely to exhaust itself. Or that's stored up in the chart through consolidation. It also shows us how much has been stored up through consolidation. It shows us when a trend will launch or pause. Do you guys think that that might be useful for you? So now we know that markets are forever oscillating between two states, which is going between expansion, trending, and contraction, consolidating. It's not on the TOS platform, but I do have the code for it, so hold off for a bit here. And we know approximately when they will begin these phases depending on the amount of energy available in the chart or lack thereof, okay? That's, again, I'll say this one thing here. If there's one thing that you can take away from this presentation, if it wasn't the earlier point that I made, then take this away from it. The markets are forever moving between expansion and contraction. You know, aren't we doing the same thing? We're forever moving between periods of rest and movement. Some people more rest than movement, some people more movement than rest, but we're all doing kind of the same thing. So how can we put this knowledge to use? Let's think about directional trading to begin with, like swing trading. So aren't your gains going to be made when the chart is fully energized and ready to explode? Get chopped to pieces. You get chopped to pieces, and then by the time that the final trend is going, you're not on board because you're sick of it. You're saying, I'm not going to enter this one. It's just going to get stopped out again. So don't you want to take profits and step to the side when the chart is exhausted and ready to consolidate? Yep. So let's look at directional trading. How can we use this for directional trading? So at the end of June, early July, this is where we say, hey, let's be prepared for a trend. Okay? And there in mid-August, we're saying, let's look to take profits or raise the stops on this thing. Because, you know, this chart's exhausted and it's likely to either coil or pull back. Okay, so we get to early September. This is where we're prepared for another trend again. This is where we're going to raise our stops and see if we can go for the final leg. And then when we get to mid-September, let's raise our stops again because this thing's exhausted. Let's look to take profits or raise our stop. And then we get to mid-October. This is where we say, let's be prepared for the next trend. However, let's be cognizant of which way the price action's going. In this case, it was actually moving to a downtrend. And then we get to mid-December again. We say, all right, look to take profits or raise stops. We get to the end of the year, and we say, here's the next trend coming. And then here we go in mid-January, we're saying, look to take profits or raise your stop. So we can use this for directional trading to augment whatever signals that you're using right now. I'm not saying that this is going to, replace whatever directional swing trade entries that you're taking. But what this can do is this can keep you out of the choppy stuff. And what this can also do is help you prepare for the next explosion, so you're not sitting on the sideline going, there it was, I missed it again, darn. Be more proactive, understand what the chart is to provide an entry signal. No reason why it can't be a system that you already use, but now you can anticipate market turns and be more proactive. So our directional trades, the only ones that we can take. Well, I read Charlie's presentation. They're talking about butterflies. So I trade options and can play neutral or non-directional trades in many different time frames. So my bread and butter is actually the iron condor, which is a non-directional trade I play generally on the S&P 500. So non-directional trading, if we want to apply this, if we see in late June, early July, we say, be prepared for a trend. Let's be careful. Okay, if I have an iron condor in play, I want to be careful that the next trend is going to start to bolt from here, and I might start to play more defense. And then when we get to mid-August, we say, okay, this thing is done. This thing is toast. Let's see if we can place a short-term non-directional trade. And then we get to early September, we say, uh-oh, okay, let's be careful here. We have a non-directional trade. We have a trend about to come into play here. This thing may run through us, okay? So be cautious. Have caution here. So then we get to mid-September. We say, let's look to place a trade up here. Now this flies right in the face of the news at the time because it's announced and everybody's thinking this thing is going to go forever. But that's exactly the time that we wanted to place a trade. And actually we placed some trade that was just unbeatable at that time. Okay, and then so as we go further on this, we get to the point in mid-October where we say, next trend is coming, let's be cautious here. There's a lot of energy in this chart and it can move, and it did quite a bit to the downside. And then we got to early December and we said, okay, this thing's come off the bottom, it's exhausted, it's going to chop for a while. And we got about 3-4 weeks of chop out of that before the next trend set up right here at the end of the year, and bam, here we are right now. So we're at a level right now where we can actually look to place our next trade in the month of March, actually. So let's build a comprehensive plan about this. What we've shown today is that markets are forever oscillating back and forth between trending and consolidating modes. If we're aware of what mode comes next, if we're proactive here, we can be more in tune with what the market wants. We can adjust our approach to the mode of what the market's showing, yes? So this is where I created an income pyramid. I have a set of stock and option strategies that I employ to fit the needs of the market. I have non-directional, semi-directional, directional index, and directional equity strategies. As I go further up the income pyramid, these positions take on more directional risk, so I use smaller positions. So at the very bottom, this is my foundation. This is where I use iron condors, so non-directional strategy on indices like the S&P and the Russell 2000. All right, so I'm going to look for those situations where we're looking to consolidate before I set these up. So I'll give these trades the largest account weighting. They are consistent winners for me in the way that I manage my risk. I can literally play these through just about any type of market. So I will look for market modes where trends are likely to stall out and consolidate, and it gives me a better edge. Next up the pyramid is semi-directional strategies. I call these semi-directional because they have to have a long-term uptrend to play them. These are like naked puts, covered calls, trades like that. So it does help to have some type of primary trend in play, a primary uptrend for me to play these. But I'm still using an S&P derivative, so it's simplifying my charting analysis. So then the next step up the pyramid is where I get into directional swing trades. After a consolidation period, we're going to look for a swing entry, which is long or short. So we've got a few different entry triggers, but the choppiness index lets us know when conditions are right for a swing. Again, we're using the S&P 500 again, leveraging the same analysis. So I'm not like trying to become an expert on 7,000 stocks. I can become an expert on one or two. So at the top of the income pyramid is where we have directional equities, which are our riskiest plays. We can play these with either options or stocks, and they're using the smallest portion of our capital as they carry the greatest risk. And we can also substitute weekly options for these to stay with the S&P 500 and further leverage our analysis. So we're going to match the market to the strategy. With the non-directional trades, I can determine when the chart is more likely to start trending and then either stay out of the way or close down existing trades, or understand when a market is ready to stall out and hit it hard with these trades. And with the directional trades, I can stand to the side when the market is chopping everybody else in the hamburger and know that with a higher likelihood when the next signal is the real trend launching from a consolidation zone. And do you guys know what's really cool? The principle of measuring the chart's energy based on the linearity of the move works on any time frame. It works on any time frame. It doesn't matter what you use. Charts. So if we have different time frames here, I have the weekly chart on the left-hand side, I have the daily on the right-hand side of this. The weekly chart shows the same pattern of behavior. When we have an exhaustion level down there at the bottom, okay, we're well below that 38.2. I think that one got all the way down to like 25 or something like that. Okay, it showed us an exhaustion level, and that's where we knew that the chart was going to stall out. And this is exactly what happened as we got into the spring of 2012. We consolidated and went into a corrected period for quite a while there. And on the daily chart, we have in mid-September where we stalled out. The same thing happens on the weekly chart as the daily chart. So the patterns of behavior are identical. They're just 5 times longer. They take 5 times longer to play out on the weekly chart. So this is what we call fractal timeframes. This factor of 5 works out very nicely across the different timeframes. They're known as the fractal relationships, where the larger structures are built from many smaller structures. So it's kind of like that old analogy where you open up this great big Christmas present, right? It's a huge box, and you rip the lid off, and there's a smaller box inside. And you rip the lid off of that, and there's a smaller box inside of that one. And you keep on going down, and there's a ring at the very end, right? So bigger things are made up of smaller things. So we can use this relationship between time frames to understand what's under the hood. That's what we want to know, right? What's under the hood? Yeah, not that kind of a present. So trends reversals begin from the inside out. So when we start with a smaller time frame, the smallest intraday time frames will start the move. And then we move up to the daily time frame, which goes up to the weekly time frame, and then finally the monthly time frame. So moves start from the inside out. Reversals start from the inside out. Swings begin from the inside out. From the smaller time frames, they propagate to the daily chart, that which propagates to the weekly, which goes into the monthly, and then you've got yourself a monster trend on your hands. Right? It's just like a family of time frames. Think about this. Those of you who have kids understand this one. Okay, this factor of 5 is just like two parents and a couple of young children between this monthly, weekly, daily, intraday kind of thing. It acts like a family of 4. The parent time frames, which are the monthly and the weekly, do not change direction very often and tend to keep going in the same direction for a long time. We've been in play for a long time. It's hard to change that battleship's direction. But the children or the child time frames will exhaust themselves more frequently. How many times have you guys been going somewhere with your kids, or all of a sudden your 2-year-old, pulls a tantrum and refuses to go anywhere, and you're literally dragging him by the hand? Come on, let's go. Well, it's going to slow you down, isn't it? Sometimes they just get tired and they have to rest, and you have to feed them, and then you can get back on the road. I mean, how many times have you guys all know this one? It's like you're trying to get somewhere, and I have to go to a rest stop. Can you stop here? Oh, all right. Well, the same things that we see with a family are happening in the market. So let's do a timeout here. We're still on track. I know that those of you who haven't been exposed to these concepts before, we're starting to boil the ocean, all right? So let's summarize and then apply this towards today's market. Linear trending moves take a lot of energy out of a market. They cannot trend indefinitely. Choppy, shallow, or reversing moves restore energy back to a market. The Choppiness Index indicator is able to measure a trend's linearity or a lack of linearity and let us know what's happening. So the Choppiness Index, again, greater than 55 is nonlinear. This thing's charged up. This time frame is ready to go, whether or not it's the monthly, weekly, daily, or an intraday. In this case, it's a daily, but we could provide this for any chart. Less than 38.2 is linear or strongly trending, and the odds of reversing or consolidating higher are much higher. Okay, so when we get down to 38.2, this thing is living on borrowed time. Let's put it that way. And then when we get down to 30, it's not gonna sustain. It's just about dead. Okay. So, summary here today. We can use the fractal relationships in the factor of 5 to determine time frames that we monitor. And each time frame's available energy will have an influence on the other fractal time frames. Let's show today's charts and discuss. So I don't have any animations here. I'm just going to use my pointer. I'm looking at the monthly chart on the left-hand side. I'm going to the weekly chart is next, the daily, and then the intraday. And what I've done here is these are approximately a factor of 5 from each other. So let's make the logical assumption that the weekly chart is about 5 times faster than the monthly. It's not exactly, but it's close enough for that time frame that it's going to work. At the very end on the right-hand side, I have a 78-minute chart. I know it's a strange chart, but if you actually divide the number of minutes in a day by 5 in a trading day in the cash index, right? And the SPX, it's going to be different for futures, but in the cash index, if you divide that by 5, it's going to be 78 minutes. And you can actually set that in TOS, yes you can. So let's look at these one at a time. Now I've got the choppiness index, or what I call the fractal energy, on here, and I'm showing in the monthly chart, it's sitting there at almost 50. That is a ton of energy. There's a lot of choppy price behavior that we've had in the last year on the monthly chart of the S&P. This thing has got a ton of energy. This thing will support a trend in either direction for hundreds of points. So that battleship is still pulling hard to the upside. Let's go to the weekly chart. The weekly chart, I would say, has got about another 4 to 5 weeks of energy to the upside here. It's sitting at 48, 49. It's still got a ton of energy left. So a weekly trend can go for a couple of hundred points. So we started at about 1340, 1350, and we can tack on a couple of hundred points before this thing is going to exhaust itself. So I give this one about 4 or 5 weeks before it's done. Now the daily, this is where we get into some interesting stuff here. The daily chart is down to 25.6. How much energy does the daily chart have, guys? None. So what's likely to happen with a daily chart from this point forward? What's likely to happen with the daily chart? Okay, I'm seeing sideways, sideways to down, sideways to down, sideways to down. Yes, yes, very good. Okay, so we're going to see sideways to down. What are we seeing on the 78-minute chart? 78-minute chart's pretty much toast as well, too, isn't it? It's got a little bit of energy left, but not very much. So what I see happening here is that we're going to have a little bit of a reaction, sideways reaction, as we get into this week. If there's any upside on the S&P, it's going to be extremely incremental. It's going to be a really tough slog, kind of like what Friday was. Friday was a really tough slog. It started off low and closed higher by a couple of points, but it was just, you know, there's not much there. It's just going to be very incremental. So, but once that's done, though, once this daily chart's back up there, we're going to have all major time frames ready to crank on this thing. So again, I'm not a bull, I'm not a bear, I'm neither. I'm just looking at this thing going, we got the two parent time frames here pulling hard to the upside. This thing can do what it wants to do, but monthly and weekly charts are both showing a huge amount of potential energy due to all the chop and consolidation. This might be starting to play out to the upside as we've seen lately, but the daily and intraday charts are temporarily exhausted, so we may see a minor reaction as we get into this week. Okay, that's what we just said. The weekly chart will not stall at this rate for another 4 to 5 weeks. So when we have a weekly chart stall, then we're going to have a reaction for maybe a month or two. So as we get into the late winter, early spring, we may see a little bit of a reaction that we have here. So again, this is the same type of price action that we've had over the last couple of years. So the next steps for you guys are to find the Choppiness index indicator, start to watch for it. If you can't find it, I do have it for TradeStation, I do have it for Thinkorswim. Otherwise, Google Choppiness index and you can find the code there and see if you can apply it to your charting platform. So start to watch the interrelationship between these fractal time frames and simplify your analysis to the bare bones. Get all those studies off of your charts. Look at price action. Understand the energies. Understand what the price is trying to tell you. And if you don't get it, or if this just piqued your interest, follow me for free. I do a blog that's over here 5 days a week under the Trading Concepts website. So just go to this blog and just look for my entries. You can go back months or a couple of years of these entries if you want to read more. You can drive yourself nuts all weekend if you want. So go to tradingconceptsinc.com and just a couple of days a week. And so go to one of my posts, enter your email, and you don't have to go there every day. You can just have it mailed to you. And with that, I've got 2 minutes left. I'm sorry this ran so long, but I'll try to catch up with you on your questions if you have any. Thank you, Johan. Thank you, Denise. Email me at this address, and I will send you the code and the instructions on how to do this for TOS. Same thing for the TradeStation indicator. If it's not TradeStation or TOS, I don't know what to tell you. You can Google Choppiness Index, and you can get the logic behind it. How to apply that to your own platform, I don't know. Don't know how to find it for the Ninja. But you can look at the TradeStation or you can look at the Thinkorswim code and you can apply it towards your own. DMI or ADX will also give an indication. I've actually done some studies on that with the ADX. ADX will typically go up to high 30s or low 40s, and then that's it for a trend. High 30s or low 40s, and that's it for a trend. That's whether it's a Russell or the S&P. So I just find the fractal application of the choppiness index to be more accurate. The FE14 is just the choppiness indicator with a period of 14. Let's see the question here. Armando, if you want the code for a TradeStation or Thinkorswim, just send me an email at this address. It's in the yellow here. Thank you, Jerry. Thanks, everybody. Okay, that's it for my time. Thanks, everybody, for spending your time with me on Saturday. And Morgan, thank you again for inviting me and having me croak at you guys for a little while. And have yourselves a terrific weekend. Thanks again, everybody. Hope to hear from you.
All right, great. Thank you, Doc. And again, excellent job. And like I mentioned earlier at the beginning of the presentation when I introduced them, I actually get emails each morning, sometimes morning, sometimes afternoon, from Doc and Todd at Trading Concepts. And you guys can actually get access to those emails if you click on that link that I just posted. And we had a tip earlier. Somebody said to be sure to open it outside the browser. Like when you click on it, it gives you a option to open it outside the Omnovia browser in a new browser. So again, Andrea, yes, we will put a recap with all the email or with all the special offers for everyone, for all the speakers we had today. Glad you're enjoying it, Rob. So yeah, I'm impressed with you guys. You know, we're in our we've been here for 3.5 hours, and we've still got 1,000 people in the room. So that's just incredible. You guys are some hardcore traders. We've got some quality education, and again, I know that every presentation up to this point has been outstanding, and I can tell you for sure that the next two are going to be just as good. So again, yeah, that's right. What is a life? So we're hardcore here. Yeah, we'll have to get the snacks next time. All right, good deal. Well, I'd like to take a quick opportunity to introduce our next speaker. I'm going to put a minute timer up. What we're trying to do is just kind of give you guys a minute break between speakers to, you know, go grab some caffeine and make sure you're tuned. But very excited about our next speaker is a good friend of mine, Fausto Puglisi. For those of you that don't know Fausto, he's actually a 12-time, yeah, that's 12, that's 1 to a 12-time trading champion at the money shows. So they have money shows. They'll put on this deal where they'll put two traders against each other, and basically, Fausto, you can probably tell us a little more about it. I don't know if it's an hour or if it's 30 minutes or however long, but basically where they'll trade against each other, and whoever makes the most money in that time wins. And Fausto has won 12 times. So, you know, if he'd only won twice, 2 or 3 times, I'd probably say he was lucky. But 12 times, you can't really blame that on luck. But again, yeah, Doc, thanks again. And again, here's that link to Doc's session. Steve was actually on earlier. So Steve was on earlier. We started off with Ross Mullins, who did an outstanding job kicking us off. He was followed by Steve Bigelow, followed by Charlie Finn. We just had Doc Severson, and we've got Fausto Puglisi, and then Raymond Stein. So we've got a great crowd. Yeah, Doc, your email is going to be blowing up for sure. It's doc@tradingconceptsinc.com. So